studying your last two. I swim med tea when they turned in. The styron down to mute. And can lend a pole that sunk he died.
When preparing a Canadian corporate tax return, one of the most important concepts to understand is how corporate income is divided into different income pools. At the top of the slide, you can see several sources of income flowing into a Canadian corporation. These sources might include business operations, bank interest, rental properties, investment portfolios, or dividend income. The first step in corporate taxation is always classification. Every dollar earned by a corporation must be placed into one of two major categories: active income or passive income. On the left side, we have active income. This is income earned from running the actual business, such as operating a dental clinic, retail store, consulting practice, or any other business activity. Active income is further divided into two tax pools. The first is LRIP, or the low-rate income pool. Income in this pool is generally eligible for the small business deduction and benefits from lower corporate tax rates. The second is GRIP, or the general rate income pool. This represents income taxed at the higher general corporate rate and is important when determining a corporation's ability to pay eligible dividends. On the right side, we have passive income. This is income earned from investments rather than active business operations. Passive income is divided into two separate pools. The first is the investment income pool, which includes interest income, rental income, foreign income, and taxable capital gains. The second is the Canadian Dividend Pool, which includes dividends received from other Canadian corporations. These two passive income pools are tracked separately because they are subject to different tax rules and refundable tax mechanisms. The key takeaway from this slide is simple. Before calculating any tax, before completing any T2 schedules, and before applying any tax rates, always ask one question: is this active income or passive income? Proper classification is the foundation of corporate tax preparation, and understanding these income pools is the first step toward mastering the T2 corporate tax return. Now that we understand the different income pools inside a corporation, the next question is, why do we separate them? The answer is simple: because each type of income is taxed differently. At the top of the slide, imagine a corporation earning income from different sources. A tax preparer is standing in front of three doors: active income, investment income, and Canadian dividends. Although all three types of income belong to the same corporation, each door leads to a completely different tax treatment. Let's start with active income on the left. This is income earned from normal business operations, such as running a dental practice, retail store, consulting business, or professional corporation. Active income is generally eligible for the small business deduction and is taxed at lower corporate tax rates. After being allocated to the appropriate income pool, such as LRIP or GRIP, the corporation benefits from preferential tax treatment designed to encourage business growth and reinvestment. Next, let's look at investment income in the center. This includes interest income, rental income, foreign income, and taxable capital gains. Unlike active business income, investment income is subject to a much higher corporate tax rate, often around 50% upfront. However, this high tax is not entirely permanent. A significant portion of the tax is tracked in refundable tax accounts and may be refunded to the corporation when certain conditions are met, typically when taxable dividends are paid to shareholders. As a result, the long-term effective tax burden on investment income is often closer to 19 to 20% rather than the full upfront rate. Now let's move to Canadian dividends on the right. When one Canadian corporation receives dividends from another Canadian corporation, the income follows a unique tax system. The corporation may pay Part 4 tax, which is currently calculated at a rate of approximately 38.33%. However, this tax is generally fully refundable. The purpose is not to permanently tax the dividend, but rather to maintain integration within the corporate tax system and prevent tax advantages from accumulating inside corporations. In the end, Canadian intercorporate dividends usually result in no permanent corporate tax. At the bottom of the slide, you can see a comparison of the three income pools. Active income benefits from lower tax rates. Investment income faces higher upfront tax, but generates refundable taxes. Canadian dividends are subject to Part 4 tax that is generally fully refundable. The key takeaway is this: the same corporation can earn multiple types of income, but each type follows its own tax rules, tax rates, and refund mechanisms. This is why proper classification is so important. If you classify income incorrectly, the entire tax calculation can be wrong. Understanding these differences is one of the most important steps toward mastering corporate tax preparation. Now that we understand the different income pools and their tax treatments, let's see how everything flows into an actual T2 corporate tax return. This slide shows the complete workflow that tax preparers follow when working on a corporation's tax return. Starting on the far left, we begin with the corporation's income sources. A corporation may earn income from many places, including active business operations, bank interest, rental properties, investment portfolios, capital gains, and dividend income. At this stage, these are simply sources of income. The next step is classification. This is one of the most important steps in corporate tax preparation. Every income source must be assigned to the correct pool. Active business income is separated from passive investment income. Investment income, such as interest, rental income, foreign income, and taxable capital gains are grouped together. Canadian dividends are tracked separately because they follow their own tax rules. Once the income has been classified correctly, we move to the T2 schedules. This is where the tax reporting process begins. Schedule 125 is the starting point and contains the corporation's financial statement information. Schedule 7 is used to report and calculate investment income, including interest income, rental income, foreign income, and taxable capital gains. Schedule 3 is used to report dividends received and to calculate Part 4 tax. Each schedule performs a specific role, but together they provide the information needed to prepare the corporate tax return accurately. Next, all of this information flows into the tax calculation engine. This is where the corporation's tax liability is determined. The tax system applies the small business deduction where available, separates income into the appropriate pools, calculates refundable taxes, determines Part 4 tax, and tracks refundable tax balances that may be recovered in the future. The result is a complete corporate tax calculation. Finally, everything flows into the T2 return itself. The return is reviewed, validated, and prepared for filing. At this point, the corporation's income has been properly classified, the correct schedules have been completed, and the final tax payable has been calculated. Notice the warning section at the bottom of the slide. Many beginners make mistakes by mixing active and passive income, forgetting to separate dividend income, ignoring concepts like LRIP and GRIP, or entering income into the wrong schedules. These errors can significantly affect the tax calculation. That's why experienced tax preparers follow a simple mental model. First, identify the type of income. Second, assign it to the correct income pool. Third, apply the appropriate tax rules. And finally, track any refundable taxes and dividend implications. The key takeaway from this slide is that corporate tax preparation is not just about entering numbers into software. It is about understanding the flow. Once you understand how income moves from the financial statements, through the schedules, into the tax calculations, and finally into the T2 return, you begin thinking like a professional corporate tax preparer.